I'm Nick Grove from Morningstar.com.au, and today I'm joined by Bentham Asset Management's Richard Quinn, who's here to discuss short duration credit. Richard, thanks for your time today.
Thanks, Nick. It's a pleasure to be here.
First of all, Richard, for the uninitiated, can you just give us a brief explanation of what is meant by short duration credit?
Short duration credit is basically something that gives you a margin over a bank bill or a cash rate. Now that cash rate or bank bill rate may go up and down, and that's why we sort of call them floating rate notes, because they float over that cash or bank bill rate. Now, key thing about short duration credit is it doesn't have that much interest rate sensitivity. So if interest rates go up, it doesn't lose value, it actually increases its yield. So it's really good in a rising interest rate environment.
Richard, what are the main benefits of this asset class, particularly for retail investors? And what advantages does it have over other asset classes such as long bonds or equities?
It's a very different asset class. It sits in the middle of the risk for different asset classes. Like long bonds and cash are seen as being lower risk instruments, and then equities are seen as being higher risk instruments. Now, credit sort of fits in the middle between those two. And it has a number of sort of benefits. It tends to generate a higher income than cash and bonds, and that's because you're taking on margin risk or credit risk. And it also can be quite resilient because it's seniority in the capital structure. You know, it has security, and its seniority in the capital structure means it's more resilient. Should you see a downdraft in markets, it may fall in value a bit, but it tends to recover. And that's an important thing with the different assets. And lastly, you know, it just has that income producing nature to it.
What is the current relative value of global credit compared to other sectors?
Yeah, this is an interesting one. I think a lot of people look at credit right now and say it's a very expensive asset class. I think when they say that, they're actually looking at long-term bond rates, because interest rates are very low right now, and we'd expect interest rates to rise. And so relative to, say, fixed rate bonds, we think credit actually provides a pretty good marginal yield. Likewise, it's not as reliant on growth as, say, equities. And one of the things we find ourselves now in is an environment that has slightly lower growth globally, and that's a key component to sort of generating returns for equities. So that you don't need that in credit.
Richard, financials dominate the credit sector in Australia. So how effectively can short duration credit diversify portfolios, especially given the prevalence of bank equities in many individuals' portfolios?
Yeah, listen, I think this is probably the most important thing for investors right now, especially self-managed super investors. They have a very correlated portfolio with bank stocks, property, and maybe hybrid bank securities. I think the thing with a global credit portfolio, you can actually diversify away from Australia and pick up a good yield and be in markets that have liquidity and an ability to invest more broadly. You can invest in industries that, you know, just don't issue debt in Australia and are very diversified relative to, say, the Australian investment, which is, you know, predominantly banks and miners.
Finally, Richard, why would investors access global credit in a managed fund format?
It's hard to do. To be honest, if you want to hedge global securities back into Aussie dollars, you know, your normal small investor can't do that, and even a lot of large investors find it difficult to do. That's one thing, it's hard to hedge it back into Australian dollars, but also it's hard to get enough people to do the research. You need a lot of diversity. You need 3 to 4 times the diversity you have in, say, an equities portfolio. And because of that, you need someone that specialises in it and has the research capabilities to cover and do the sort of in-depth research per issuer. And, you know, that's why, you know, a lot of large superannuation funds use us.
Richard, thanks very much for your time today.
Great, thank you.